Good afternoon, everyone, and welcome to Libro's webinar, Entrepreneurial Risk Management, Life Insurance Strategies for Your Business. My name is Paul McQueen. I'm the Vice President of Wealth here at Libro Credit Union, and on behalf of all of my 700 plus Libro colleagues, want to welcome you to today's seminar, either live or perhaps you're watching this on a replay after the event. Before we get started today, given our commitment to truth and reconciliation and the National Day for Truth and Reconciliation, it's important that we begin today's event by acknowledging the history of the traditional territories that we are all connecting from as we gather together virtually. Libro Credit Union supports communities across southwestern Ontario, and we would like to respect and acknowledge the longstanding relationships of the local First Nations and Indigenous peoples who have inhabited this land from the beginning. Within our service area, we acknowledge the traditional territories of the Neutral, the Attawadarun, the Haudenosaunee, the Anishinaabe, the Lenapehoak, the Algonquin, the Lenni Lenape, the Ojibwe, the Chippewa peoples. We also recognize the contributions Métis, Inuit, and other Indigenous peoples have made, both in shaping and strengthening communities across southwestern Ontario, our province, and country as a whole. Although we are connecting virtually today, we are grateful for the opportunity to be on this land in southwestern Ontario, and we thank all the generations of people who have taken care of this land for thousands of years. So, our presentation today is going to be talking about life insurance, and what we've talked about is how real entrepreneurs embrace risk. They assess it, they exploit it, they overcome it. And we're certainly going to get into some of the strategies and approaches, some of the whys, some of the steps forward that we can take in business as business owners to take advantage of some of these opportunities and to plan for some things that maybe we don't always like planning for. A little bit about Libro as we get started. We could skip ahead one slide there, please. Our presenters today are going to include myself. I'm going to be joined by Phil Boglewski, who is our wealth planner. He's a Libro employee who works as also a trust and estate practitioner with that designation. And we're also joined behind the scenes by Garrett Graham, our senior manager of commercial markets, both of whom will be able to answer questions that may be applicable. Now, our slides seem to have dropped off, so I'm not sure if we're having a slight technical issue behind the scenes. There we go. There's Phil, picture of Garrett. A little bit about Libro. We have 36 locations across southwestern Ontario, well over 108,000, now over 110,000 owners, I believe, over 700 employees. We're very proud to be a B Corporation certified. We believe that our business can be good for our owners and also good for the larger communities that we served, and that's reflected in our purpose-based business model. A few housekeeping items for today as well. Just because of the nature of this presentation format, we certainly can't see you, so we certainly encourage you to please add your comments and questions into the Q&A section that is available to you. We have found having done a number of these webinars that general questions do tend to work best. If you have something that's really, really specific to your personal situation and your business that might not be repeatable or might not have a larger scale impact, we'll certainly take those questions offline and have a discussion with your local coach. But please feel free to put the questions in there. And if you missed something, if you want to go back and review, note that the recording will be available to you after the call, and there will be some handouts that we provide to all participants, so you don't have to take furious notes. Anything really important will be captured for you. A little bit about our presenter today. We're very proud to be joined by Doug Carroll. Doug is the tax and estate specialist for Aviso Wealth. Aviso Wealth is our wealth manager partner at Libro, and for many, if not most, of the credit unions across Canada. Doug previously ran an estate planning law practice and was an advanced case consultant with both a life insurer and a mutual fund provider. Doug holds a business degree and a master's of law specializing in tax and is qualified as a certified financial planning professional and a trust and estate practitioner. He's been doing this for over 25 years now. We've done a number of these calls together, which we've been really pleased with. He supports our financial advisors from written articles to individual case consultations and, of course, webcasts like this one. So without further ado, I'd like to turn it over to Doug Carroll.
There we go. Just waiting for my microphone to kick in here. I wanted to keep out of the way while you were speaking there. I've got it running now. Paul, am I good? I just want to make sure you can hear my sound. Okay, good. And I got my my slides going here. The topic, as you mentioned, is about entrepreneurial risk management. And sometimes when people see the words, the combination of words or phrase life insurance, it can be scary, and it's not terribly comfortable to contemplate having the need for life insurance. But having the need for life insurance means that you have something of value and you need to protect it. And so it is important to understand where life insurance fits, because you're going to need to look at all the risks that might be associated with running your business, one of which is the loss of one person who owns or is a key contributor, whether or not an owner of the business, in different ways that can impact both the business and the family. So that's what we're looking into here today. And in doing this, I'm just going to switch up my my slides as I'm moving them forward here. And there we go. Okay, so I'm going to take you through the the topic here, and I've got 8 subtopics. But as I do these, if any of you have attended previously, you may know that I generally say, here's as much text as you're going to see on the screen, and here's as many slides you're going to see, 1 through 8. In this case, there are a number of sub topics or breakdowns that I've got here. Once I get into the number 4 there, the 4 fundamental needs, I'm going to blow that out larger in a few different ways. So more text on the screen, more slides are going to run off of that. But other than that, it's not going to be a crazy light show that I'm going to take you through here. I'm going to start off by just laying out the general groundwork of where insurance can be helpful to understand the principles involved with it, and then get into the core needs that we have with insurance with this framework that you see at number 3 here, 5 insurance questions that then are applied to the follow-up 4 insurance needs, or the 4 core fundamental insurance needs that we have. I'll then, with that as the bulk of the content, I'm going to move over and talk about the tax features that life insurance can serve where you have a corporation, and how it is that, or why it is that that's important with a corporation to address the potential high tax rates that you might see with excess or surplus money in a corporation, that you may end up facing more, not loss necessarily, but decline in available assets if you're not focused on the net of tax implications. And then I'll take through a few more points about strategically how the insurance can be used to assist with that, and a final comment on insurance for the living. So not just about life insurance as the unfortunate payment of life insurance is a person's death, but other types of insurance that that might apply, that you can make use of in a business operation. So again, a really general few points that I want to make here first about the nature of a business, not to tell you your business and what you're facing, but just as an acknowledgement of what it is that you're facing as a business owner. You are in a different position than somebody who is a straight up employee of somebody else's business, whether it's a small or a large business. You own the business, you are an employee of the business, and so the goose and golden egg type of view of things does really very much apply. It is both the place where you are reapplying your wealth. When you receive in your hands, you're putting it back in to keep growing this thing up. And so it's the goose that you own, and it does feed you golden eggs. Hopefully they're golden eggs that are coming out to you. What you have to be aware of is, if you're no longer there to generate those golden eggs, or to turn the crank on the machinery that produces those golden eggs, then you've got family who are there and behind you, who you support your whole current life and your future expectations for yourself, your spouse, for your children if they're young, or just generally for their future, it is very much dependent, certainly in the early years, on your ability to continue to contribute. And where your wealth is bound up in this one very tightly wound place, then if something unfortunate happens, like a death of you as an owner, then not only do you lose the income, as would be the case where you have a straight up employee elsewhere, but you also lose potentially or have a significant decline in the assets that you own and that you can then pass on to the continuing family and on to the children if you're not there. So that's where we get over to look at life insurance, and really it's protective. It is intended to provide a means for people to protect against the really significant loss if there is a death of a person, where by combining your wealth and your exposure to risk, you're able to pay a relatively small year-to-year premium cost, so that if the unfortunate event happens, then the payout will be sufficient to sustain, protect, whatever the purpose is for the insurance. You are going to have that relation between the small amount from year to year and then the large amount which would come into the hands of those who need it if you were to die, that then can keep things going or can replace what it is that might be lost. In insurance terms, we talk about the phrases or the words risk and peril. They're common words that might be used interchangeably in general language, but risk is the possibility that somebody or something will happen, and more properly, it's the probability that it may happen. And then peril is the damage that results if it does in fact come to fruition. So we want to make sure that we determine what risks are out there, what kind of peril would associate with that, and then see what we can do to put life insurance in place to try to lessen the effect of that coming about. We also have phrases that you might hear like term and perm, as in term insurance and permanent insurance. I'll get into this when I talk about the specific applications of insurance, different applications for a business. But essentially what it means is term insurance for a set period of time, or permanent insurance that will continue on irrespective of the calendar time or the year-to-year time. It needs to be in place according to your exposure, regardless of how much time it is. It is permanent in that your death or the death of a person will cause certain harm, regardless when that happens out there in the future. Whereas with term insurance, that's the kind of alignment of need where you have a relatively shorter exposure than in a person's whole lifetime. And so you have a particular term that you choose to apply the insurance, and thereafter you may not need that insurance. It might be because there's some kind of project where there's significant risk of loss of that person, or perhaps borrowed money that then gets paid back, at which point the lender doesn't require you to have that insurance in place. So that might be an appropriate term insurance need. And then one last thing about the insurance principles that I've taken you through, textbooks and textbooks of explanation of what this is in detail. But one last thing I want to touch on here is the notion of levelizing life cost. And what I mean by that is that the cost of insurance is generally on insurance policies that's set out by the insurance companies based on the expectation that you're going to continue to pay the premiums on the policy. And what happens with insurance policies is if you take a short-term type of insurance policy, then you're going to have your cost spread across that short term. And let's say it's 5 years time frame, then you'll pay the cost of the insurance over the course of that 5-year time frame. And then you're 5 years older, and at that point, then you'll have another time period, and I'll just stick with the 5. And at that point, because you're older, then things will bump up in terms of the cost. If you have permanent insurance, then it's not a matter of statically saying this 5 years and that 5 years and that 5 years. It's a levelizing of costs that happens over the course of the entire lifetime that you're expected to continue to live. And so although permanent insurance and longer term insurance might have higher premiums at the front end of things, it does tend to then equalize, if you want to look at that way, as you get out later on in your years, because in your later years, you're paying less than what you otherwise would be paying based on your age as you continue to get older over the course of years. And quite often, permanent insurance policies will allow you not only to pay what you are required to pay in the current year, but you are allowed, subject to tax rules that limit you doing too much of this, you're allowed to pay beyond the requirements of the insurance policy. And when you pay beyond that, that excess money is surplus cash that is inside the insurance policy. And the insurance policy, depending on the particular offering of the insurance company, will allow you to invest that in some way. Sometimes it's fairly straightforward interest-bearing investments. Sometimes it is the insurance company that invests that for you. Other times it's more elaborate, the choices that you can make. So setting up your life insurance can be quite complicated. Again, I've compressed a whole bunch of things into one place here. I just wanted to lay out those features before we get into the applications of insurance for business purposes. So there's 5 questions that I like to break this into that will apply to any application of insurance, but particularly where we're talking about business applications. I break it out this way, and I'm using these icons that I'm going to bring forward when I'm talking about each of the applications. So it's both the words that I'm showing here and the terms, but also the icons that I want you to just take a look at, and I'll bring them back as I'm talking about each of the applications. So what purpose does the particular application of insurance serve? And just, I know it sounds really nebulous right now, but just hold on to that thought as we talk about the particular purposes. Secondly, what is the duration, or how long is the insurance needed? I talked about term insurance versus permanent insurance. So this is what I'm looking at here, is the time period that that applies is going to affect the choices that you make about how much insurance you will put in place. The question then becomes, who should own the insurance where you have a business? That might seem obvious. In the personal insurance world, you would own insurance on yourself, or as a couple, you would own insurance together, and your lives would be insured on insurance policy. With the business application of insurance, it can become a little bit more complicated, particularly where we're talking about corporations that might be involved, whether it's appropriate to own at the corporate level versus the personal level, whether when you have multiple corporations, if you have a holding company and you have an operating company, whether it makes more sense in some cases to hold at the operating company level versus the at the holding company level versus the operating company level, and where you have multiple owners who have their respective holding companies, how you might break things out there as well. So who should own the insurance then coordinates with who should receive the insurance proceeds. And when I say who, I'm not necessarily talking about a natural person here. I'm talking about who as in the entity, which may very well be a particular person, but it may be the corporation, a corporation, or some variation again with the holding companies and the operating companies. It may also be a trust in more complex situations where you need to have more control over how the insurance proceeds are dealt with. And then the last thing is probably the first question that people usually think of is how much coverage do I need and how much is going to cost me? We're not going to get into any dollar figures, any numerical examples here, but yeah, you have to look at how much is needed. When I look at it in terms of the amount, I'm looking at the principles of determining the appropriate amount, not actually doing the calculation as we're going through the materials here. So there are 4 core needs for insurance that we have. Income replacement, which is actually a personal need, but where you're the owner, manager, owner employee, then you have a need for income replacement that now is overlapped very significantly with the business that you own. So that's the starting point. The fundamental purpose of insurance is income replacement, and then all other needs then follow in behind that. So we've got income replacement, we've got key person coverage, buy self-funding, and then estate taxes. And I'm going to take you through each of these. As I said, I was showing you the icons there because I wanted you to see what it is that I'm doing with each of these statements that I'm making off of the needs. And I'm going to just give you a little bit of comment on this, just for your comfort level. We've got an article. It's an article that I wrote, which is it parallels the content in the PowerPoint slides that we've got showing here. So don't feel like you have to madly scribble down the notes of these things opposite each of these points. There is a more detailed, not extreme, but more detailed rundown on each of these in that written piece that we'll be sharing with you. So income replacement, the whole idea of income replacement is that you are replacing the lost earning capacity of someone who had been a breadwinner, a key contributor to the household. Perhaps it's as I sometimes refer to it, it's a party of two, or it's a full house. But there's no longer the contribution that person has been making, and so what can we do about that? Technically, it is a temporary need, because what you're doing is you're replacing that person's income earning capacity, and most people don't continue to earn significant income throughout their entire lives when they live a really ripe old age. At some point, you'll no longer be working, in which case there is technically no need for income replacement coverage. There may be there may be need for insurance for other reasons, but the income replacement is no longer there if the person is no longer owning or is no longer producing income. And as I'm looking here at who should own the insurance, I'm assuming that we have a corporate structure. We don't have to have a corporate structure, but assuming you have a corporate structure, then I'm just using the phrase each shareholder, each person likely owns the insurance on themselves. So despite that you own a business and could have the insurance owned at the corporate level, on first view of it, it should be seen as you owning on yourself. You may, based on a fuller analysis when you sit down and have a conversation with an insurance advisor, you may determine that it is appropriate for you to have that insurance owned at the corporate level, particularly if there are no others who are involved in the business. If it's your corporation alone and there's no one else who might have a claim to it, then it might be very streamlined and efficient to have that owned at the corporate level. But otherwise, what we're looking at is each shareholder, directly or indirectly, owning the insurance on their own life. And then in terms of the payment of the amounts involved, it's intended that it goes out to support the spouse and the family via the estate of the deceased person. The amount that's involved, and as I said, I'm not talking about the dollar figures directly, but the amount that's involved that you would have as the face value of the insurance, and I know that insurance advisors would hate to hear this as a comment, but really it does decline over the course of time. Chances are that you will set it at an appropriate rate, which is intended to replace the income that you would otherwise produce over the course of your continuing working years. And you may revisit it from time to time, but I can tell you from personal experience, and I'm sure that you've probably run into this, the idea of giving back on insurance, particularly if you're in a good position where you could continue to afford the premium on it, the idea of knocking it down or knocking it back gives you this feeling like, oh my gosh, if I do that and then I die, get hit by a car the next month, I did have $1 million and now I'm down to 500,000. I've given that much less to my family. But again, purely technically, it's a declining amount that would apply for the amount of insurance you would have for income replacement purposes. Usually, though, you're going to be looking not at each insurance need completely in isolation from other needs. You're going to be looking at that as the part of the analysis to determine what you need for that particular reason, and then others that you would want for other reasons. And as it turns out, your declining need for insurance on an income replacement basis doesn't directly correspond, but it tends to move in the other direction. As it's declining, your need for insurance for some other purpose might actually be going up. So the idea of just canceling out insurance is not what you would likely do, you would at least notionally in your head, or specifically in terms of how you own the insurance policies, have a declining amount that might be applicable for income replacement, but an increasing amount for other purposes, particularly where it is for dealing with terminal taxes, as you've got a very well established and positive business operation. That's going to mean increasing value, which with it comes quite often increasing eventual tax liability on a disposition, which is deemed to happen at death. And I'll talk about that one as the fourth of the needs that I'm speaking to here. Second item is key person coverage, and with key person coverage, what happens is you are trying to make sure that you are supporting the value of the business itself. So it is protecting the business if someone who is a key contributor is no longer there. And it doesn't have to be a person's death, but we're talking about life insurance. It could be somebody becoming disabled. It could just be a straight up departure of someone, which is a risk associated with the business. But keeping it to the life insurance, the idea here is that the owner of the business is probably the number one concern for the loss of that person, but also someone who's in charge of your distribution, of your warehousing, of your factory operations. They may very well be sufficiently key that you want to have insurance coverage, so that if they're lost to you, lost their family, unfortunately, but also lost to you as a business, then an amount of insurance will come into the business to sustain it until it can get itself back onto a level keel. So it's needed in terms of time for as long as that person will effectively be a contributor to that business as an employee or an owner of the business, which is it may very well be that it's a temporary need. But if this is someone who you, leaving yourself aside, if it's someone who you do have a good relationship with, you want and hope they will be an ongoing involved person in the business. And so you're looking outward during the life of the business, this person is hopefully going to be there for you. The ownership of the policy is likely going to be the corporation itself, and it will pay the premiums on it. It will come out of corporate resources, and it will receive the insurance proceeds. And when the insurance proceeds are paid to the corporation, then it can be applied to a variety of purposes. It might be to buy some time by bringing in some temporary help. It may be that you're going to put in place some additional technology that, again, will allow for everything to settle, and then eventually to hire someone who will replace that person. That's what you're looking at doing. The value of the insurance, or the premium, or not the premium cost, but the face value, the death benefit of the insurance, would be based on this person's contribution into the operation. Quite often, where you have a small number of shareholders who do have a buy-sell, it's the next topic that I'll move on to, who do have a buy-sell agreement in place, the need for insurance based on the key person might be combined with that buy-sell, and the ownership might be connected in some ownership of the insurance might be connected in some way with that, whether it's directly in the operating company or held again at the holding company level. It could be that the amount of the insurance is determined in combination with the eventual buy-sell that would happen, because the death of someone who is a business owner will be a loss to the business of that person as a key contributor, but also will cause the shares of that person to then be disposed, and there would then have to be discussion about what will happen with that ownership interest. Now, hopefully, there's a buy-sell agreement in place that would have been negotiated at an earlier point in time, when you don't know if you're going to be the buyer or the seller, as in the survivor or the deceased person, in that negotiation, so that you're going to be negotiating based on something that's much more objective than what would happen if you had not yet put this in place, and then a death happens and you've got the negotiation happening between the surviving shareholder or multiple shareholders and the spouse, perhaps, of the deceased person, who then is put in a really difficult position, apart from the personal grief, to have to negotiate through what's going to happen with the transfer of the ownership interest. And that spouse, who may be involved in an entirely different business altogether, or employment, or not at all, is going to be in a difficult position there. So having a buy-sell agreement in place is really hand in hand with putting life insurance in place for buy-sell purposes. And that's what I'll talk about directly here, moving on from the key person, is the idea that business owners quite often will have the bulk of their assets. I talked early on about the goose and the golden egg. Quite often, the assets, the wealth of the business owners will be significantly tied into the business itself. It may very well be that there are other large and small assets that have been acquired, but in terms of having full liquidity to be able to buy one another out, that's going to be a real challenge in a lot of, if not most, businesses, that there's readily available liquid assets, or on the other hand, that there are sufficient assets that might serve as collateral to be borrowing for the survivors to buy out the deceased person's interest. It may very well be the case, but a more dependable way to look at it is, if you could put life insurance in place, then you don't have to negotiate with either your current lender or some other lender and pay the interest charges associated with that. Putting life insurance in place, understanding that there's a premium cost to putting the life insurance in place, you can have a pretty clear picture of what it's going to cost you to protect against that. I wouldn't call it an eventuality, but the potentiality of there being a death that has to be then funded, and knowing exactly how much is going to come about at that time. That may not be the exact amount which is needed to serve that. There needs to be still a calculation of what is the value of the interest of the deceased person, but having that cash readily coming at the point of the person's death will make it much more manageable to get through that really difficult phase of the relationships involved and the business itself. So it is a temporary need, again, technically a temporary need that applies only while the business owners are owners of the business. And so it's something that you might say, well, we only need it on a term basis because we're not going to keep working, die with our boots on, regardless of when that's going to happen out into our 80s, 90s, etc. But when you think more broadly, again, not looking at each of these needs, though I'm breaking them out for the sake of the analysis as completely distinct from one another, there's a lot of overlap. And there might be a current need at the early stages of things, which might morph into a later application of the current insurance policy, the current coverage, to apply to another need. So don't get stuck in the idea that it is technically temporary and therefore the type of insurance like term insurance would be applied for this purpose. You may very well look at this and say, yeah, it is temporary, but in the broader view of things, there is a permanent need across the whole range of needs that we have. And so making sure that there is an understanding for yourself about the nature of term versus permanent, the costs that are associated with it, and the conversation you have with your financial advisor, your life insurance licensed advisor, will then help you understand the business deal that you're getting into. So again, as with the key person insurance, it tends to be that the corporation will be the owner of the insurance on all the shareholders, or it could be that each of the shareholders own insurance on the others, or there might be a policy on each of them where all the others are the owners of that other policy, because the purpose of the insurance is to allow the survivors to get the cash to then apply that cash to purchase the interest, the shares of the deceased person. It doesn't make sense. It doesn't make sense to have insurance owned by the person who is expected to die, or obviously you're not going to get insurance from an insurance company where someone is right on the verge of expecting to pass away. But where the purpose of the insurance is for buy sell, then you don't own the insurance on your own life. It's others who need it. And when I say others, it may very well be that it's the corporation owned by everyone, which sorts out what's going to happen with that money, driven by or guided by the terms of an earlier negotiated buy-sell agreement, so that the survivors get their multiple shares coming from the deceased person. They get to continue running the operation. And again, the cash, the net value of the business interests of the deceased ends up back with the family. So the routing of the money may be different according to whether it's corporate owned or it's personally owned. As well, if there are holding companies involved, it might have a few stages to go through. And as I mentioned earlier, as opposed to the declining value or application of the insurance need for income replacement, with something like the growth of the business, your value of your shares goes up in that case, in which case the buyout need gets higher on the ownership interest and the buyout that is needed at the point of a person's death. So yeah, a lot of moving parts that are involved here. Again, trying to break it out so we can look at the components, but then we have to mix it all back together when you come up with your strategic approach for all of your risk protection, and particularly the risk protection for the death of a person. And the last of the core or the fundamental needs is to deal with estate taxes. I referred to this earlier. It's again an increasing insurance need, because just as with the buy sell, your interest in the business grows larger. Hopefully it grows larger. It's getting bigger. As well, the growth in that value is subject to tax on the capital gain. Some of the capital gain might be captured or covered by the lifetime capital gains exemption, which is up to about $1 million right now, that might be protected from being taxed based on each person's holding of the business. It's on a per person basis. So if you had two spouses, for example, as owners of shares of a business, then each of them would be able to protect $1 million of capital gain. But otherwise, it may be that the capital gains exemption doesn't apply in your circumstance based on the assets and the way that you've managed them. Maybe the capital gains exemption has already been used, and maybe it's a large business that's well beyond that million of gain, and so there will be tax that will apply on the excess beyond that. So the concern that we have, what we're trying to address, is that the capital gains are realized when we sell off assets, but also when there's a deemed disposition of assets. And that includes when a person dies, from the person over to their estate, there is deemed to have been a disposition or sale of those assets, and a capital gain arises at that point based on your cost base and the market value, the difference between the two being the capital gain. You can roll your assets over to a spouse at your cost base, so you can defer off the capital gain. But eventually, on a second death of the two, then you're going to have the capital gain being realized at that point, and taxes applying. Now, even if you can roll over from one spouse to another, if that spouse has not been involved in the business, then likely that spouse does not want to continue to be engaged in something with people whom he or she has had long ongoing contact, but doesn't have a direct business relationship. And so despite the rollover from one spouse to another, nonetheless, it could be that in short order, there will be a disposition, an actual disposition, even if not deemed at the initial shareholder's death. The actual disposition might have to happen in order for the surviving spouse to harvest out the value, which now is over into their hands, which was originally partly, if not wholly, in the original shareholder person's hands. This is a permanent need. We're assuming that the business grows in value and it is owned at the point of the person's death, and therefore it is a permanent need regardless of when the person's death occurs. You'll have a capital gain and tax on that capital gain. As with the income replacement, Technically, each shareholder would own on themselves, though again, it may be that it's combined with corporate-owned insurance, that the insurance proceeds and the structure of the insurance policy might be set forth so that it addresses multiple needs. Very important to have a clear shareholders agreement that says what's going to happen with the insurance when it's owned corporately, because if there is no clear picture of what is supposed to happen with those insurance proceeds, then once the person dies, it leaves things up in the air, and it's a recipe for argument at the very least, and litigation and significant cost in the worst case scenarios. So ultimately, the money is intended to get into the hands of the surviving spouse and family, so that the deemed disposition, the taxes that would apply, can be paid off, leaving the assets, the value of the interest of the deceased person as intact as possible for the benefit of that family and shareholders, of the family and the surviving spouse. And as I mentioned, it's based on the capital gain, and it is connected to the availability of the lifetime capital gains exemption. So that gives you your four fundamental needs. As I said a number of times, you you can't really look at each of these things completely in isolation. But if I talked about it as one big ball of wax in total, it would be that much more confusing to try and get your head around. And so I like to break it out across these four main needs. And then the deeper conversation that you have with your insurance advisor will allow you then to focus attention on each of them and how they connect to one another, and then come up with a strategy of how you address those issues. Now, once we've established a need for insurance in one of those core purposes, the next thing that we may be able to do with that life insurance is to use it to address some of the concerns you have with corporations and their passive investments, or their portfolio investments. A corporation is a really good tool for running an active business, for doing widget making, whatever it is that the business does, where you are actively engaged in earning income. Where you have excess cash then, and that excess cash is not needed to plow back into the operations. You don't need to buy any more machinery. You don't need any more inventory. You're in good shape with that. It's now excess cash. You could pay that money out to yourself as shareholder, and you would pay the tax going from corporation over to shareholder on the dividend, or you could invest money at the corporate level. The tax rules, they don't want you, or governments generally, or tax policy doesn't want people to be using a corporation as a passive investment vehicle, because it's intended to allow for you to build business and to reinvest. It's got flat tax rates that are lower than what personal tax rates might be, so that you can reinvest in the business, buy that plant and equipment and inventory using cheaper corporate dollars once you've paid the initial taxes at the corporate level, rather than having to pay the full bore of taxes out into personal hands and then reinvesting. So you can get a business going, and you can sustain it more if you can make use of a corporation. But if you have passive income that you're generating, then the rates on passive income are quite punitive. They effectively emulate what would be the tax if someone was a top bracket individual. So it gets it up to around the 50% tax rate. That's originally or initially what the corporation faces. The corporation then is allowed to get a refund of some of those taxes that are paid at the corporate level once dividends are paid out of the corporation and over to the shareholder. So in order to not face those high tax rates and have that refundable tax, which is uninvestable money on deposit effectively with the Canada Revenue Agency, one of the things that you can do is make use of the fact that you have life insurance for a defined purpose, and put excess money into those insurance policies, which allows for the money in that insurance policy to grow on a tax sheltered basis and eventually pay out on a tax efficient basis out to the corporation and then over to the shareholders or to the surviving family. So here's the basic representation of this, where we've got a simple version of this: a corporation where there's an individual who is insured by the corporation, and it's going to be the owner in this simple version of things. A life insurance policy will then cover for the defined need of the individual who's involved here. And what happens with the corporation is it can use its dollars to pay the premiums on the life insurance policy. Sometimes people think, well, you can get a tax deduction for the insurance premiums, but really what happens is it's not a tax deduction, or it's not something where you directly get a reduced rate involved. But because you're using the corporate dollars, instead of dividending out to personal hands and paying the tax on the dividend, you're using less costly dollars to buy the same amount of insurance at the corporate level that you otherwise might buy at the personal level. And then when the person dies, the insurance proceeds are tax-free when paid out to the corporation, which owns the policy. It names itself as the beneficiary. And then depending on how long the policy has been in place, how much has been deposited into the policy, then some or all of the insurance proceeds that were received tax-free by the corporation can then be paid out tax-free to the surviving shareholders or to the family. Now, there's two last things that I want to touch on. I'm going to touch on these really briefly. I know, Paul, that you'd like to come back in here, I'm sure, and deal with any questions that have come up. So I'll deal with these fairly quickly. There are other applications of insurance beyond the core needs. There may be potentially that the lenders you have want you to have insurance because they're subject to your availability to run the business and pay back the money that's lent to them. So that's another application of insurance, is the lenders wanting you to have insurance in place in order to lend money to you. You can also use insurance as part of your employee benefits. So having group life insurance for the benefit of your employees is an efficient way to allow them to have a base level of personal life insurance. Retirement compensation agreements or arrangements are retirement savings vehicles that are actually taxed in a negative way. And because of that, life insurance is a way that you might house retirement compensation arrangements and use that tax sheltering feature of the insurance to try to reduce or not be facing as much of that negative consequence of the RCA, retirement compensation arrangements, that you otherwise would face. And the last thing here is about charitable giving. You can donate personally, you can donate corporately. Keep it simple and say that it's just you, your corporation, and no other shareholders involved. It may be more efficient if you have a cause that you really care about and you want to make a donation. It may be more efficient to donate at the corporate level, which is a deduction to the corporation, rather than dividending money into your personal hands and donating personally. And then layer on top of that the features of the insurance, particularly the tax sheltering growth and the tax-free payout on the insurance. And it could be a really effective way to set up how it is that you do your philanthropy. Last thing, and I'm not going to go into these in any detail. Last thing is that, as I said off the top, I'm talking about life insurance, but there's other types of insurance. There's disability insurance. There's insurance for health needs. There's a variety of ways that insurance can be used to address a whole range of risks that you might face as a business. And as I mentioned earlier, the broader conversation you have with your insurance advisor, you can get into these other applications. So Paul, I'm going to bring you back in here, or let you take over to come back in here and see what questions might have come up, and whether Phil and Garrett have some comments to enter into things. So back to you, Paul.
Perfect, Doug. Thank you. Appreciate that. Yeah, there are a couple questions. The first one is relatively straightforward: is does Libro offer these kinds of insurances? The short answer to that is yes. The more complex, nuanced answer to that is we do offer it through an affiliate organization. So in partnership with our dealer, Aviso Wealth, we have a distinct offer referred to as Libro Wealth Strategies. today. And Libro Wealth Strategies operates as a distinct organization from Libro Credit Union. There is a distinct website, etc. And we would take care of, you do have insurance choices, and we certainly have owners who have worked with our Libro Wealth Strategies team directly. So yes, we do have qualified people to engage in these types of conversations. The next question, I'll leave this one with you, Doug. Since the insurance is for my family, doesn't it make more sense for them to be the beneficiaries instead of complicating it by going through the corporation?
Yeah, ultimately you want the money to get into the hands of your family, but tax rules can be very picky about using corporate assets for personal purposes. So you need to route the money through the corporation and allow for the tax rules to eventually get it out into the personal hands. If you directly name personal beneficiaries off of a corporate-owned policy, then you run the risk that the premiums that you paid in the first place might be treated as a taxable benefit to the person who's the shareholder, whose family are named as beneficiaries. So that's one of the possibilities. The worst possibility, and I've never actually seen this, but it's always something that's warned about, is the potential that the entire insurance proceeds might be treated as a taxable benefit by having them come directly out of the corporation, effectively appropriating corporate assets. So just be aware of that you're going to have to negotiate or navigate the tax rules, getting the money from corporation out into personal hands.
Okay, thanks, Doug. Another question for you then. If I want to buy the insurance I've heard that if I want to buy the insurance in my corporation, I may need to set up another corporation or maybe even a trust to do it properly. Is that really necessary? Or is that perhaps an it depends answer?
Yeah, it is an it depends, but part of that is there was a time when the Canada Revenue Agency's administrative procedures and the way that they interpreted the Income Tax Act, you needed to have to steer clear of some of the negative tax consequences. You would set up, or accountants and lawyers would recommend setting up a holding company for a variety of purposes, and then having the insurance owned up at the holding company level in order to avoid some of these negative tax consequences. The CRA now has pretty much said, we don't care if you set up the holding company or if it's the operating company, we will still apply those. I shouldn't say they're negative, but we will still apply the tax that is appropriate, whether you've got the multi structures in place. But again, the more complex your business is set up, the more complex your needs for insurance that might come from that, then you may have to be looking at having the insurance located in a holding company rather than an operating company, and possibly having a trust in place, which again is conversation with both the insurance advisor and with your lawyer and your accountant, so they can coordinate their respective areas of expertise.
Thank you. All right, so the next question from Saeed here. This seems rather complex. And I may actually bring in Phil. I may bring in Garrett and then Phil shortly here. So this seems rather complex. What's the best way to research and create a customized plan for a corporation's owner's particular situation? And absolutely, yes, there is some complexity. There is always an it depends response, as every situation may be unique, dependent on both the goals of the corporation and the goals of the owner or owners of that corporation. My short answer is just get started, start a conversation. And I was thinking maybe I could bring in Garrett from our team for a moment on how we might start those conversations, and then perhaps Phil on some of the work that he's done in this space. Garrett, if you're available.
Yeah, hi everybody. Well, the easy answer to this is to start with your business coach. So we've got a team of business coaches at Libro, so account managers, relationship managers, specialists. That is the best spot to start your conversation. They are not experts in insurance, but they will certainly be able to guide you on your next steps and get you in touch with those experts. And so, yeah, it's just a matter of starting that conversation with your business coach who knows your business already, and they can direct you from there.
Excellent, thanks, Garrett. And Phil, maybe an example recently where we've incorporated insurance planning into Obviously, we have to respect the privacy of our owners, and we're not going to give overly specific answers here, but some, perhaps an example of where this has been useful for some of our Libra owners.
Yeah, thanks, Paul. I think that what we see the most often is that individuals don't want their silent partner to come in and ask for a significant composition of what they've built, and the silent partner being the Canada Revenue Agency. So what we really see quite a lot and wind up implementing are strategies using the flexibility of life insurance that we can then design a specific plan to deal with a tax bill or creating an amount of wealth for a child that's not going to be involved in the business. So it's very, very highly flexible and a malleable tool. It's for those individuals that want it and may not necessarily need it. So we definitely have the expertise. Paul, you had mentioned that we are positioned to deal in this landscape, and I think that's very important that our listeners and participants today understand that we have the ability to access all of the insurance carriers across Canada, those being the largest insurance companies. Libro itself does not provide life insurance. We have the capabilities to broker any required insurance deals. So I'm hoping that helps a little bit.
Perfect. Thank you, Phil, and appreciate our tech support here on the back end as I'm throwing some of these questions around and making this look seamless for our owners. Doug, I think this last question, just in the interest of time, is for you before we wrap up today. But what would be some major life events or potential life events where a sole proprietor should consider incorporating to further manage risk?
Well, I would say that this is this is not an insurance question so much as that it is a business needs type of thing, where when you're running a business and you're at the point where you don't need to have all that money coming to you to be buying the groceries, paying the rent, etc., then you may very well be better off to run through a corporation in order to get access, as I mentioned, to the low flat tax rates of the corporation so that you can get more reinvestment happening at the corporate level. And then that will allow for that excess money that you've gotten to, that gravy position you've taken yourself to then have that money not being used for taxes immediately, but instead being deferred off to be able to use for personal purposes. And using the corporation can put that money somewhat in a holding pattern, as Phil was talking about, the silent partner of the Canada Revenue Agency. You may very well have to eventually pay the taxes, but if you can pay it at a later point in time, then you've got more use of that money to either plow back into the operation or to set aside into investments, including the potential to then make use of life insurance for those core purposes, and then perhaps for those more advanced tax sheltering purposes that I made mention of.
And you may have touched on this already, Doug, just in terms of risk management, because you touched on this at the beginning here of your answer of it being a business decision, that there may be certain liability protections of the corporation in terms of versus the personal proprietor, a sole proprietor type model. Would that be a fair statement, or?
Yeah, I think that. Yeah, so I think that with a personal sole proprietor situation, your own assets are directly exposed to potential risks of things just going sour with the business and having claims against you directly. Setting up a corporation, not for tax reasons, but rather for the protection of having an isolated place where the business is operated, may give you a little bit more comfort and some real creditor protection against the possibility of claims coming directly against you. So it wouldn't necessarily be airtight, but it certainly creates that additional level of protection that may allow you to sleep a little bit more comfortably.
Well, thank you, Doug. I appreciate all of the great insights and the education that you've provided to our listeners, our viewers today. I want to thank everyone for their time on today's call. If we didn't get to a specific question you have, or you didn't feel comfortable asking a very personal question on today's call, which is understandable, please know, as Garrett noted, you can just start your conversation with your local coach, whoever that happens to be, whether that's one of our, commercial, agricultural specialist coaches, whether that's one of the members of financial planners on our wealth team, whatever it happens to be. You can start these conversations. We can talk about the use of insurance. We can talk about how it might apply to your business. And if, when it was appropriate, to refer you to an insurance specialist because of the type of insurance or how much or those kinds of things, we have that capability as well. We've been very impressed with some of the opportunities that we've had to help our owners take care of some significant planning requirements, whether that was risk between partners, whether that was family succession issues, whether that was prepayment of tax. Insurance may, not always, but may play a strong place in that financial planning solution. We're here to help. We're here to have those conversations with you. And again, thank you for your attendance today. And we look forward to speaking with you shortly. Enjoy the rest of your day. Go Jays, go. Have a fantastic afternoon.